this company, I like that phrase, over to independence with all the choices and all the things you need for your clients. One of the reasons I wanted to introduce Kalisha tonight, who's going to help orient you and train you on the best product in the industry, particularly for retirement income, is I've had the privilege of working with Allianz Life for over 30 years from their very beginnings. And I think it's most important for you to know that with what you do for your clients and your prospects is you make promises, and you make promises that need to be kept. And that's really the background I want you to realize with Allianz. Every step of the way, not only do they lead with great premium and accumulation, but their dedication to their producer force and helping you along with anything that happens. We always get the troubleshooting done really quickly. We have clients who enjoy their statements and all the access they have to the values that they're growing leaps and bounds within their product. And, Allianz has been a real leader in the annuity world as well over all these decades. So it was only a natural that their fixed indexed annuities would be wrapped into the most productive and exciting life product, IUL, that they've been able to master. To show you how good they are, there's one product. You don't need a lot when you've got the best, right? So it makes it simpler for all of you to, again, take notes and realize that when you run your illustrations and send some information to your clients, know that it's for the long haul. These promises go out 10, 20, 30 years, sometimes longer, depending on the age of your client. So it's really important that you have the confidence in the company. So I thank you again for your attention. I'd like to introduce Kalisha right now, Kalisha Thodi. She's our regional vice president from Allianz. She is nationally known for her expertise in advanced markets, as well as for the newly appointed producer. She has so many stories to share from all the sales activity that have occurred over the years that she's been with the company. And it's a real pleasure to have her come on. Tony, are you going to take questions as we go, or at the end? How do you want to work this format?
I'll actually let Kalisha kind of tell us how she prefers it, and I'm sure we'll follow along, no problem. We can do in the middle of it, no problem. Typically, if it's while she's doing the training, the best way to do it is to type it in the chat box. If it's going to be afterwards, we'll just make sure we shave off some time for some Q&A, but I'll let her kind of decide which one she prefers.
Great. Kalisha, take it away.
Fabulous. All right. Thank you so much for the extremely kind words, Marianne. I greatly appreciate that. Everyone can hear me okay? Are we all ready to rock? It's a real disadvantage for an insurance wholesaler to not be in person and be able to open a tab or a happy hour after a training event such as this. So I'll do the very best that I can through a computer screen, but I realize that it's not the same. Tony, what I did is I do have some slides to run through. I'll usually just go through and then do questions at the end, if that works. Oftentimes I end up answering questions kind of along the way. So at the end, I'm happy to go through and take however much time you want to give me to get through them, or I can answer them after the fact as well. So if you'll give me just a moment here to share my screen. And all right. So do you see a PowerPoint in front of you? Fabulous. All right. All righty. Give me one moment here to put this in its proper format. All right. So as Marianne had mentioned, hi, I'm Kalisha. I'm the Regional Director of Sales at Allianz for the life insurance side of the house. We are known primarily for being an annuity giant, so I'm very excited that you are spending some of your evening learning a little bit more about our life portfolio, which, as Marianne alluded to, is fairly short and sweet, being that it's just the one product. I will try and hustle through this relatively quickly. I know that many of you are relatively new to us, so I wanted to kind of level set, give you some good notes on the company, kind of give you some good speaking points about the product, kind of what differentiates us from other IULs that you might be used to, and then hopefully we can take it from there. So a little bit about Allianz. We're going to go through, like I said, kind of some of the high points here. So company strength. If you're anything like me, you're probably sick and tired of hearing about these unprecedented times and these, this uncertainty, this pandemic situation that we're in. But really what we have found is that, more than ever, company strength has kind of come into play in a way that has kind of taken us by surprise in the last 12 to 18 months. But what I'm going to do for tonight is kind of go through the 5 bullet points that you see in front of us here, and then spend a little bit of time talking about our rate lock feature, as well as the launch of our auto lock, which is actually going to be tomorrow, May 4th. So you guys are getting this information a little bit ahead of the curve. And this will hopefully take us, less than the allotted hour as promised. So I'm not going to spend too much time belaboring what a fixed indexed universal life policy is. The things that you see on the screen there, the death benefit protection, accumulation potential, tax advantages, living advantages, these are really, these are why, right, we sell and clients purchase these kinds of policies. One thing about the Allianz Life Pro Plus, right, our Life Pro Plus Advantage product, we've really focused our time and our energy on the accumulation potential. If you are looking for, the highest death benefit that a dollar can buy, that is not going to be our product. We've leveraged, our internal hedging team and our considerable expertise, to really build what we feel is the best accumulation product on the market. And that is really where, we've kind of embraced that niche and really run with it. So a couple of notes about Allianz as a whole. So Allianz Life of North America, which is in the Twin Cities of Minnesota, where I am based out of, is a subsidiary of Allianz SE, which is our parent company. For those of you that have ever traveled through Asia or through Europe, you know that you'll see Allianz signs everywhere. It is ubiquitous. It's like seeing State Farm signs here. It is one of the largest companies in the world. One of the top asset managers, one of the largest insurance companies based on both of assets and market value. And one thing that I do want to call out, as I had mentioned kind of just a few moments ago, in this situation that we're currently in, ratings have become more important than ever, right? We've seen a number of carriers, maybe about a year ago now, when all of this started to hit, that dropped their rates. They cut off some of their rate classes. They restricted how much premium would come in. They've sold off different pieces of their business or acquired, private hedge funds or private equity funds as investors. Allianz has not had to do any of those things. Again, because we are part of this giant kind of powerhouse, we have maintained, it's been fairly, it seems almost crazy to say, but it's been more or less business as usual over here. We had our ratings reaffirmed in October of 2020 by both S&P and AM Best. And they reaffirmed us. There was no change from our ratings, pre-pandemic or during the pandemic. And so that, I think, really speaks to kind of the way that we manage our business, because that's looking not just at our sales and our profits, but that's looking at the overall, risk management of the entire enterprise, the operating profits, all of those things. So kind of as Marianne said at the beginning of this, Allianz has stayed steady and is, in a great spot to, make good on all of the promises that we have made to our millions and millions of clients. We're going to jump ahead a little bit with the loan flexibility. I typically prefer to do this kind of more at the end of a presentation such as this, but it works with the CLIMB acronym to hit the loan flexibility a little bit earlier. So one thing that I do want to say is this: from strictly a sales perspective, if you are talking about an IUL where you're talking about cash value accumulation, then your policy is really as good as two things. It is how you're going to grow the money inside of the policy during the accumulation phase, and it's how you're going to get the money out on the back end. And, you know, we're seeing this with a number of whole life carriers right now. You know, I think it was Ohio National that has just demutualized. We're seeing a number of 1035 exchanges come over from that company because the loan provisions, the ability to get money out of those contracts is just not where it needs to be. Something similar with Northwestern Mutual, where, you know, those old whole life policies have done what they're supposed to do. They've grown the cash really well inside the policy all those years, but now the dividends are coming down and the loan rate on those policies is at 8%. Well, no client wants to tie any part of their retirement income, you know, or its guarantees to that kind of a number. So Allianz, right, and what's commonly done in the IUL space is that you'll see a couple of different types of loans. There's a variable rate, and then there's an indexed rate. The indexed rate, right, that we have is locked in at 5%. And this is really important because what many carriers will do is they'll put a variable rate in there. And so when you run a sales illustration for your clients, you know, that will reflect at 4 or at 4.5 or at 5%. But in the fine print, that could go up to 6 or to 8. Or in the case of some of our more aggressive competitors, that can go all the way up to 15%, right? Imagine selling a product to your clients and after they put their money into it for all those years and they go to take it out, the loan rate could be double what they were initially shown. Allianz doesn't play that game, right? We've locked it in at 5%. It's guaranteed for the life of the policy. One other thing I will mention is that we have the ability to allocate our loaned and our unloaned values separately. And again, that might seem fairly far into the weeds. That might seem like something that doesn't really matter, but again, think of it this way, especially with longevity, you know, kind of being on the rise in our country, more and more people are living to be, you know, 85, 90, 95, 100. Some people are taking loans out of their policy for almost as long as they've been.
Kalisha, if you can hear me, we lost you. I think your call disconnected because you were calling us in. If you want to turn on your computer, turn on your microphone. I got a feeling she was calling us on the cell phone or her cell phone died. Huh? No. Hang tight, guys. We're going to give her a moment to go ahead and get on.
Too.
You're good. Don't worry about it. Go for it. It's all yours.
All right. Thank you for bearing with me, team. So I'm not entirely sure where I had cut out before. I think I was still on this slide and just discussing the importance of being able to allocate your loaned and your unloaned values separately. You know, for many clients who, you know, if they're taking loans out of their policy, whether it's for college funding or, you know, retirement income, whatever the case may be, they might want to have, you know, just something a little more conservative for those loaned values where, you know, they just want to be able to get some positive arbitrage, make sure that they're clearing that 5% loan fee. And for their accumulation value, right, the rest of that value, maybe they still want to swing for the fences, right? Maybe they're still trying to get as much value, you know, as they can, or as much growth as they can out of that. Well, for those folks, right, you can separate, you can put your loan value into something that might be a little bit more safe or a little bit more predictable, and you can still allocate your accumulation value separately. So to the best of my knowledge, Allianz is the only IUL carrier that will let you do that. And it's something that we talk about quite a bit. Indexing experience. And so Marianne touched a little bit on this in her opening as well. So Allianz is considered something of an innovator within the indexing space within the insurance industry. So our actuaries created the monthly sum all the way back in 2005, the blended index in 2008, trigger in 2013, the volatility controlled indices in 2014, and then the index lock in 2019, and the auto lock, which I mentioned is launching tomorrow. So it is kind of a cool story for us to be able to go through and kind of show that we were the first ones to market with these different strategies. And now those have been copied, right? And those are replicated at other carriers. And many of those things, if you look at the monthly sum or the volatility controlled indices, those are something of table stakes for many carriers. So the story for us to be able to talk about how we, were the ones that came to that first is really cool. Oh. All right. So the one of the things that I did want to touch on with this indexing experience piece of it is that Allianz is one of very few carriers to have their own hedging team. So what that means is that for most carriers, they are partnering with, an investment bank, some third party that's going to manage their money for them, right? They take it, they wait until they have enough money with, all of their premiums, and then they kind of go out in a tranche, if you will. And that's what typically creates sweep dates, if you've ever heard of that. Well, Allianz, right, being such a juggernaut in the fixed indexed annuity space, we are selling, buying and selling something like $2 billion in options a week. And we are able to do that because of the enormous volume of fixed indexed annuities that we sell, but we're able to leverage those benefits across all lines of business. So our variable annuities and, of course, our indexed universal life product. That is something that also distinguishes Allianz from a number of its competitors. So not just in the way that we come to market with these new indexes, but also some of the features like the index lock and the auto lock. We are able to offer those to you and subsequently your clients because of our hedging team. And so here's just kind of one example of how our indexing experience is bringing value to our customer. A common client objection in validating the illustrated rate is, like how, right, you've shown me this illustration, that's great. What is the likelihood that this illustrated rate is actually going to be what I'm going to get? So while past results are not always an indicator of future results, we all know the kind of illustration jargon for that. This is helpful, I think, for your clients to kind of understand the historical point of view for our policies. So this bar chart that you're looking at here shows how policies issued in each year would have done. And we are looking at calendar years here. So we're not cherry picking our dates for them to be the most favorable or anything like that. The average credited interest rate over the life of the policies that's issued, right, out of all of those, if you go back and look, our average interest credit on the index side is at 6.9%. And on the fixed interest side, it's at 4.16. So when you're running a sales illustration and, the software currently lets you show, I think it's 6 or maybe 6.15%, you can feel confident in taking that to your client because over time, even before we had the benefit of the rate lock or the auto lock, our policies have still outperformed what our maximum illustrated rate is showing. And then the microsite. So I know that a number of you are relatively new and you're coming on board, getting contracted, getting set up. So something that I wanted to point out, you can see down at the bottom here, this www.allianzlife.com/life sales tools. That is a public website. So there are a number of things that are behind our login. So once you get contracted with us, you can get in and everything is out there. If you are still, kind of going through that process, and I know that can sometimes be tedious, you can still go out, you can take a look around. You'll be able to see the majority of our sales and marketing pieces. And with that comes, all the information on the product. There's a number of different videos and different sales kits, and a number of our advanced markets pieces. So tax planning, premium finance, foreign nationals, estate planning, all of that. we have basic pieces out there that cover all of those things. And so those can be shared with your clients as well. Everything that you find on that site has been client approved. So just trying to make it easier, on you all to be able to go to one site and be able to find all of those things. Another thing that I wanted to mention, actually two, so this one and one more, but the backcasting tool is rolled right into our illustration software. So one of the things that we hear quite a bit, right, as Allianz has a number of proprietary indices, another thing that clients will commonly ask is, how would this stack up against, the S&P 500 or, the NASDAQ or something that they might be a little bit more familiar with. Well, we actually have the ability to show them that.
Oh, no. No.
All right, hang tight. Looks like she's having some technology issues. I apologize, guys.
All right. All right, so where had I cut out this time? I think as I was going through the backcasting tool.
Yeah, you were talking about backcasting and how you can compare rates to the more traditional, commonly known indexes like the S&P and such.
Yeah, okay, perfect. So, kind of tying the Allianz having the hedging team, creating some of our own indices and kind of going that extra mile or having those extra advantages, to be able to deliver those extra benefits to clients. I think the industry standard, it's about 65 to 70% of all IULs are allocated to the S&P 500. And that makes sense, right? That has name brand recognition, if you will, as far as indexes go. Clients know it. It is what it is. But if you think about this kind of through time, and if you look back, the S&P 500, if you look at any, rolling 5, 10, 15, 20-year periods, it'll be up about 70 or 80% of the time. And when it's up, it's way up. When it's down, it has crashed and completely bottomed out. Well, we run sales illustrations at 6 or 6.25 or 6.5% and show that year over year over year and take that out to the client. If you're allocated in the S&P 500, that is exactly what that index does not do, right? That's exactly what, it's not designed to do that. And over history, it has never done that. So we, believe in our indexes, right? And they have performed over time. If you look at that last slide that we were talking about with the, our policies, even with all of the ups and the downs that we've seen in the marketplace, have earned almost, close to 7% all the way back. Well, we want clients to have that same confidence, right, in our product and in the indexes that they're choosing that we do. And so we kind of created this tool that's part of our illustration software. So your client can see how this would have performed over time, right? How it stacks up against other indices, including the S&P 500, and just what the differences are, right? So really from a marketing perspective, wanting to give you as the advisor that power and that control to kind of be able to show them that. And then the Allianz Showcase. So this is the other thing that I wanted to mention quickly. So this is another supplemental tool that's designed to kind of provide some of that additional education to your customer, more around like the working mechanics of our products. So with the changes that have come with the AG 49 regulations that were just implemented back in December, a number of carriers, Allianz included, saw something of a change to their illustrated values, right? So the maximum illustrated rate has come down a little bit. The positive loan arbitrage that can be shown in illustrations has changed. It's gone downward. And that's the same for all carriers. That's not just for Allianz. But for us, we really wanted to be able to show your clients how their different bonus options would look, right, based off of the selection that they've made. So this essentially will allow you to generate a case study, again, right on the fly, right at that point of sale meeting or in doing that financial planning meeting with your clients. But you can generate this as you sit there. This is another component of the illustration software, and then you can review it with your clients. So with the different bonuses that have, that are available, and we'll get to that next, as you can see here, but we've really gone out of our way to create some marketing pieces that help your clients understand exactly what their choices are and what that impact is, and then explain that to them every step of the way. So in talking about different bonus options, let's take a look at that. So the different bonus options, as you can see here, kind of on that sliding scale from left to right, I view this as kind of a spectrum from the most conservative to the most aggressive, if you will. So there is a standard option, which is no bonus. It is, plain Jane, if you will, which comes with some slightly higher caps and participation rates. The classic bonus, right, again, as you see there, exactly what it sounds like. It's 0.9% or 90 basis points. That is a guaranteed flat rate bonus. The bonus selection, that 15% multiplier bonus. So for example, if your client got, say, a 10% for the sake of easy math, then they would be credited with 11.5. So it is 15% of whatever the client earns. And then the select index, which you see is kind of, it's a little standalone over here. So that is a 40% multiplier bonus with a 1% annual asset charge. So again, from a competitive landscape view, Allianz was, prior to some of the regulatory changes being made, Allianz was put in the position of, wanting to stay competitive with a number of other carriers that had come to market with these, big bonuses and, some of these, but some of those were coming with some pretty strong fees attached to it. For example, one of our competitors laid out kind of a tier of different bonuses that you could choose like a 20 or a 40 or a 60% bonus, but that would come with a 2 or a 4 or a 6% asset charge. Well, at the point in time, if you get a 0 and you could lose 6% out of your contract, that is starting to look and feel a lot like a variable product, or perhaps even just being invested in the market with some sort of buffer. So what we did, again, leveraging some of the strength of our hedging team, is that we were able to come up with the 40% multiplier bonus for a 1% annual asset charge, which we felt could be, presented to our clients and is a fair risk versus reward scenario. So with this one, right, kind of which option is right for your client, there's a little bit of a client profile here for each one of these. So, for the standard bonus, someone who just wants simplicity and is looking for those higher caps and participation rates is happy with that. The consistent bonus, right, the classic, they think that the index would return less than 6%, and they just want that, that safety. If you're looking in the purple, that 15% multiplier bonus, thinking that the index would return greater than 6%, which is similar to that select bonus, right? That 40% multiplier opportunity, where those are the people who are the most aggressive, right? They're willing to pay that asset charge for the potential of, that bigger bonus. With the advent of our rate lock, which first came out in August of 2019, the vast majority of our options that are coming in are the bonused or the select. The bonused, I think, opportunity, again, no fee for that one with the 15% on top of whatever you're credited. Extremely popular with clients of all demographics, who are looking for that potential. The select index, again, right, it depends on your client profile. I have my own policy with Allianz. That is the option that I chose. I'm relatively young. I'm going to hold this policy for a long time, and I pay attention to my policy, and I'm going to utilize the rate lock. And I think that not only is the index going to do greater than 6, I think it's going to be worth it to pay that 1% annual fee for the 40% bonus. So with some of the chatter about the rate lock, let's talk about that one for a little bit. This has been it's been absolutely instrumental to the success that Allianz has seen over, you know, the last couple of years. And it's a huge piece of what is built into our growth plans for, you know, the next couple of years to come. So let's talk about this for a little bit. So the index lock is exactly what it sounds like. It is the ability to lock in an index value on your crediting methods during like mid-year, right? Or any point during your contract year. So what we had been seeing quite a bit of is, you know, the volatility in the markets has been incredibly high over the last few years. I don't need to tell you that. You likely won't need to tell your clients that. But, you know, the unfortunate thing about that is for many of our clients, they would be on track to have a really great return coming up at the end of their contract year, right? Coming up on their anniversary. Well, something could have happened in the market where, you know, the indexes, you know, took a tumble, everything came crashing down. And if their contract anniversary hit before it had rebounded, well, then that event could have wiped out part or even all of that return that they were looking like they were likely to receive. So we wanted to find a way to be able to help clients mitigate that and to not make them so, you know, reliant on kind of the whims of what was going on in the market. So the index lock, right, gives you guys the ability, right, and the flexibility to track and view the index values online, to lock in index values at any point in time during the crediting period, and then it will reset on the following year, right, so your clients can do it all over again. So that is an extremely fancy way of saying that we are going out of our way to help clients basically minimize that risk of mid-year volatility, right? So say, for example, your clients, you know, they open a policy tomorrow, the beginning of May, and by the beginning of October, it's climbed to 10% or 12% or 8% or, you know, whatever it is that they're happy with. Instead of having to wait until the next anniversary, right, they can lock it in right then. It'll essentially freeze for the remainder of that policy year. Whatever they have locked in at is what they will be credited with when that contract year is done. And then it will unlock at that contract anniversary and they can start again. So we still work off of the principle of annual reset, right? So this isn't some like high water mark where once your clients get to, you know, 8 or 10 or 12% that they have to get there again before they'll ever see any sort of increase. This is still going to track the actual values of the index, right? And they can, you know, they can track that and they can basically utilize this every contract year for as long as they hold the policy. So this is available on our volatility controlled indices. So that is the Bloomberg US Dynamic Balance Index, which is something of a mouthful. We typically refer to that as the BUDB, and then the PIMCO, the Tactical Balanced ER Index. So both of these indices, they are proprietary to Allianz. We have partnered with, it was formerly Barclays and has now been bought out by Bloomberg, and PIMCO. Allianz and PIMCO are actually sister companies. Allianz SE owns PIMCO. But we have partnered with, you know, these very well-known market giants to be able to, you know, use these indices that are actively managed by our hedging team here in the Twin Cities. So it's been a very, very cool story for us to be able to tell to our advisors and to our clients. You know, if you look inside the BUDB, it's made up of the S&P 500, the Barclays US Aggregate Bond Index, which are industry benchmarks in their own right. We're just able to, you know, kind of merge them together, shift the weighting. When volatility is high on one side, we shift it more to the safety of the bonds. When the markets are more stable, we shift more of the weight of the index over there. But again, it's really, you know, fascinating to see. If any of you are market people, if you're ever in Minnesota, please let me know, and I can give you a tour once the world has opened back up a little bit. But again, right, our hedging team here has gotten so good at what they do that they are now hedging for all of Allianz worldwide. So on average, we sell and trade about $2 billion a week. And part of the reason that we are able to offer tools, you know, like this rate lock, and one of the reasons that you won't see it at other carriers, that they just do not have that kind of operation, at their home offices that we are so fortunate to have. So there are a couple of different ways to lock in the gain on an FIUL policy. So the manual lock, right? So you can, I know some clients, even if you're actively managing the policy for them, or if you have the ability to go in and do that, some clients are particular. They want to manage their own things. They want to be able to go in and look, and they can absolutely do that, right? So you can access the Allianz site, right? You can, if you're happy with where it is, right? The client, they can go in and they can select that and lock it in. The auto lock, which I have talked about a little bit, in which we are formally launching as of tomorrow, very excited about that. So this gives you the option to basically set an upper target on that index lock feature, right? So once you reach it, then it's automatically going to lock in. So essentially, when we had first rolled out with the rate lock period, right, which is only in its manual format, we did kind of a soft launch, if you will, or we're gathering field feedback from some of our field partners, such as yourself. And they loved the idea of being able to help their clients minimize some of that mid-year market volatility. But for some of them who have big practices, right, are really, really busy people, they're juggling a lot of different things, perhaps, assets under management as well as the life and the annuities. The one piece of feedback that we heard is, what, this is great, but this gives me one more thing to manage, or one more thing to try and keep track of and remember. Because some clients will want to look after this themselves, but many, if not most, right, they won't. They're going to expect me to do this. Well, that's how we started thinking, and that's kind of where the genesis of this idea for the auto lock came from. So not only are we releasing this, but we are now going back on all of our existing policies that are on the books, and we are adding this feature onto them. And so that's one other thing that I will spend just a minute talking about here. We've heard from a lot of clients and a lot of advisors who have been in the industry for quite some time. And one of the things that always, if there's one thing that really, raises the temper of longstanding agents, it's when carriers will reduce the in-force rates all the way down as far as they can go, or close to that, and still keep those new business rates high and shiny and attractive to those new clients. Allianz, again, right, does not play that game. Now, that's not to say that we never have rate changes, right? Just if you look at the course of the past year, the volatility in the markets has kind of spiked the cost of some of those options that rate changes were unavailable or unavoidable, pardon me. But those changes have been proportionate both to our new business and to our old business. And for our rate lock feature, again, I think I mentioned that was released in August of 2019. We went back, starting in 2020, and added those indexes and that feature onto all of our in-force policies that we have already had on the books. So our clients that bought policies with us in 2006 and 2007, before our hedging desk had the capabilities they do now, right before that was ever dreamt of, they now have access to all of those same, benefits and all of those same new improvements that our new clients are getting. So we're really proud of, the commitment to in-force business that we've shown. So if any of you, I know many of you are new, but if some of you have, written with us in the past, maybe moved to a different carrier, if you have existing policies that are on the books, please, let me know. I can help you run a report, figure out, when, or, based off of contract anniversary, when you could expect to see these new features coming onto the policies that you may have sold previously. So just a couple of things about the benefits of the auto lock. So again, that is one less thing for you to have to manage, right? It kind of provides that convenience of locking in the interest rate by being able to set that target. Once the index value is locked in, that is protected from any negative index performance, right, until the end of the crediting period, which is always going to be that contract year. And again, right, always thinking of you, our partners in the field, trying to make it easier to find the allocations that are available to be run So for many of our producers, again, as mentioned, if they've been selling with us for a long time, or there's a lot of policies and it's a lot to keep track of, there is actually a function where you can go into the website and just run an index lock report to see which one of your clients can utilize that feature. And you can filter it by different rates of return, right? So for example, if you are all part of the same group, I can run a report for your group, right, based off of your upline on a weekly basis, or you know, Tony could probably do that himself. And he can say, okay, here are all the policies we've sold that could be locked in at 8% or 9% or 10, right? Whatever you want to set that number to. So we're really, you know, insurance can be long and tedious, right? Illustrations are 50 pages and application packets are 80, right? If we're lucky. We realize that some of that's, you know, out of our hands from a regulatory perspective, but we are doing our best to try and make this an easier process in terms of managing your clients that are through us. And if you have any feedback, please, you know, let us know. Like I said, that is how the whole idea for the auto lock came about. And now it's something that is getting a lot of chatter within the industry and that we really and truly believe will help people. So always open to that. All right, the interest rate percentage. So if you are on the website and you are looking, you know, if you're trying to keep track of a specific policy and you're trying to see, you know, what percentage they're at, the rate that you'll see there has already been adjusted for the participation rate and the multiplier bonuses. So I did just want to make a point of that. You know, we had talked about some of the different bonus numbers. You know, if your clients are in 15% or in 40%, it's really common to see clients that split those. They go 50% one, 50% the other, whatever the case may be. Don't worry, we're not going to make you get out your calculator or try and do any long division or anything like that to calculate what they're actually going to get once everything is said and done. That number is already going to be reflected. So what you see on the screen is in actuality what the client will receive. So let's take a look at a quick case study here. So in this case, right, we've got Mark and Rosa. They own an Allianz Fiul policy. They're a financial professional, that is one of you, has recently talked to them about setting targets on their existing policy to give them the opportunity to kind of lock in those gains automatically. They discuss it and they decide that they're going to set that upper target at 10%. All right, so during their crediting period, the interest rate goes all the way up to 10.05%. Right, so this has activated the target of the 10% to kick in. Now, what's interesting about this is at the end of the day, right, because the interest at the end of the day in this example is at that 10.05, that is where they are going to lock in at. So, of course, as we all know, right, markets can fluctuate throughout the day. So if your client set this target at 10%, right, and it gets to a certain point, but by the end of the day, right, that percentage is down to 9 or 8, it's not going to lock in, right? So it's not going to capture that before your clients are able to take advantage of it, I guess, if that makes sense. So if it gets up and comes back down, they're not locked in. However, if they hit that 10% and it goes up from there, right? In this case, it's 10.05, but if it got up to 10.5 or 11, that target, right, that auto lock is going to kick in and actually lock them in at that higher period. So I thought that that was a really, you know, a really cool little feature that we were able to run with there. So again, right, our hedging team can work a lot of miracles, but they are still people and the markets are still the markets. So, you know, what we've seen over the course of the last year with, you know, world leaders and politics and, you know, pandemic events, markets have absolutely gone up and down, you know, several percentages in a day. So if we can give your clients the benefit of doing better than what they asked for, we will. But we're absolutely not going to lock them in if it happens that, you know, it went up and came back down. So they can do better, but they can't do worse. And one thing that I will mention here is that, you know, if say your client set their target at 10% or they went, you know, really ridiculously high, like 20%, if the market didn't get as high as the target that they set, then they're still just going to get the real return of whatever that index did. So this isn't like a use it or lose it. Like if your clients, you know, have auto lock and they didn't lock it in, that they get zero or anything like that. It's still going to track what the actual, you know, what that crediting method has done.
And I apologize, I didn't capture that completely. You said something about if they lock it, but then the market does better. Does it capture the better?
It does, yes. So that is what I was trying to get across, and is perhaps not so eloquent. So apologies, let me go through that one more time. So yes, right, I advanced the slides a little bit here, right? So in this example that we used, right, of Mark and Rosa, they've set their target to 10%. At the end of the day, right, it was at 10.05. So that is what they are going to be locked into, right? So if at the end of the day, right, when the markets close and everything is done, if that auto lock has been generated and the number has gone higher, then they're going to get the benefit of that. They're going to get whatever it closed in at, right? So if this had locked in at, if in this example, if the market had gone up to 11, they would have locked in at 11, right? So they're going to lock in at whatever that higher number would be. However,
how long will that
if
lock
it had gone, so that is for the remainder of the crediting period. So that is for the rest of that policy year. So whenever the rate lock is targeted, right, whenever that's locked in and that's what your clients have got, that is what they are going to be credited at the end of their policy year. And then it will unlock on the next anniversary and start again.
So if they wanted to, like hypothetically, right, they put it at 10%, the first 6 months of the year, the market does 11%, then the system's going to automatically lock them at 11, which is great. If they wanted to manually bring it back down to 10, could they?
At the next year. So, and thank you for bringing that up, because that was going to be one of my next talking points. So there is, once it's locked in for that year, then it's done, right? So they can't go back and monkey around with it, you know, in between the middle of that if they've already utilized it. They have the opportunity to do this each and every policy year, but it is once per year, and you can't go back from that, right? So, for example, you know, say that let's use this example, right? They set it at 10, and it went up to 10.05, and then 2 months later it's at 12. They can't unlock and then lock again at 12 in the same year. Right, so you can use this once per policy year. Okay,
I get it. My concern was more if it went down. Like, for example, again, same scenario, right? I'm the client. Yep. I'm the client. I want to lock it in at 10. First 6 months of the year, it's at 11, so it auto locks at 11. But then the second half of the year, it does, you know, 10.3. But on one, you know, maybe first on the third quarter, and then the last quarter, it just takes a nosedive and it averages out to 6. I couldn't go back to the original 10.
No, that's exactly why we created this, right? So you lock in at 10, you're locked. So the market takes an absolute nosedive and bottoms out and goes to -10. It doesn't matter. You've already locked in at 10. That's what you get.
Unless, but that's oh, I see. Yeah, no, I get it now. Okay, thank you. You just answered it for me. I processed it myself.
Okay, well, you know what? This is perfect, because I'm actually, I'm coming up on the end of this here, and with the technical difficulties, I want to be respectful of your time, because I know you have some other things to cover yourself. But did you have any other questions for me, you know, while I'm here, or anything else that maybe wasn't clear or got lost in some of tonight's issues?
Does anybody have any questions, guys? I've got a handful of them, but I want to make sure if you guys do, you know, you ask it, and then afterwards I'm gonna kind of talk about some of these things to make sure that Anybody that is a little bit confused can kind of say, hey, I want to know what's up.
I just have one question. I know you mentioned 2 indexes. It was Bloomberg US Dynamic. And what was the second one?
PIMCO, Tactical Balanced. So I can actually go up to the screen if you want. And I mean, we have marketing pieces on all of these if you want to be able to read about the components or the history. But then there's also the websites that you can go out to. There's trackers. There's all the rest of it. So you can go as high level or as far into the weeds as you would like. I got trapped on a call with an options manager and had to talk about duration overlay. It was very traumatizing. But all of that is out there.
And which one is the one which is the sister company that Allianz owns? Is it PIMCO?
That's PIMCO. Yep.
Gotcha. Okay. I saw Lulu had a question. It was actually my question as well too. Do you accept non-residents with Itins?
Okay, so we do have a foreign national program. It's based off of country of origin and, like residency, I guess, within the United States. So like, I mean, for example, we work with a number of agents or a number of advisors who, have a foothold or a niche in the like H-1B markets. So people who are skilled foreign workers who are here as engineers or IT or something like that. That is not a problem. If you are looking for people who are true non-residents, like they don't have a social security number, or they're here on like a tourist visa, we do not take those.
Gotcha. Yeah, so non-resident, when Lulu, non-resident, you're talking about people that just have Itins, but they don't have any actual status. They don't have no visas, they don't have anything, and whatever they did have expired. Is that what you're talking about, Lulu? Correct. Okay. So we don't have a market for that. Okay. Anybody have any questions? I got a couple.
Yeah, let's hear them.
Okay. So and you might have answered this. I was just capturing as much info as I can. My hand hurts from taking notes. The lock rate, that's not a rider, that's an automatic, correct? That locking feature?
That's correct. So that's tied to the indexing options. So if you choose, one of the indices that you see on the screen, that comes with that. Okay,
gotcha. You answered one of the questions there, but just to confirm, I can lock it for a calendar year, right? Based on, policy anniversary date, but I cannot unlock it to go back. I can't flip flop back and forth. So once I lock it, I'm locked in for the remainder of the year until the very next anniversary date, correct?
Correct.
Okay. And what would you say is a recommended locking percentage based on your experiences? Like what would be, is that a daily thing that the client could monitor on a daily basis, and when they see it hit that number, lock it in? And if so, what's that sweet spot interest that you want us to keep an eye out for?
Yep. So absolutely, right, to answer your question, right, the clients, let me see, I think I had a blurb about that as well, right? So the clients can do that manually, or they can do that, right? They can set the auto lock. Right. For me personally, right, I have my own policy. I'm also an insurance wholesaler, but I didn't set an auto lock, or I'm not going to on my policy, because I'm going to keep my eye on the policy and I'll lock it when I want to. So for anyone that has a policy with us, right, you set up an account on allianzlife.com, right? You register for it just like you would anything else online where you have your account that's tied to your policy. You can go in, you can see the values of the index. They translate that to a percentage, so you can see exactly how your policy is doing. So if your client wants to go in and they want to look at it that way, absolutely, right? They can go in and they can take a look at that at any point in time. I guess the targeted sweet spot, that's tough. That's gonna, I hate this answer when it's given to me of, it really depends on the client. But it kind of does depend on the client, right? The average illustration is currently at 6%. If this is part of a bigger, financial picture, and the client's got a set number where, that's what they're going to be happy with, then phenomenal, right? Set it there. based off of what we've seen, I currently have my like alert set to ding when it goes past 12. Again, right, I'm younger and relatively aggressive in my risk tolerance, but from what we've seen, I absolutely think that it's feasible for those indices to surpass that in a year.
Gotcha. Okay. And I don't know if this applies to this or not, but the loan, when money's borrowed against it, is this a participating or a non-participating type of a plan?
So there's two different loan types. So there's a fixed interest loan. That's at 2% for the first 10 years of the policy, and then is a wash in years 11 and on. So that would be a non-participating loan. The 5% that was touched on in this presentation is a participating loan. So that has all the same benefits.
Refresh my memory real quickly if you can on participating and not. I know what they do. I'm just trying to make sure I get the definition locked onto the right one so I could train on this afterwards.
Yep, absolutely. So the fixed loan is exactly what it sounds, right? You take, you are going to pay your 2%, or, in the case of years 11 and on, it's a wash. You borrow money from your policy. That money is gone from your policy. You didn't pay anything for it. That's great. The participating loan, right, at the higher rate of the 5%. So it's higher to take the money out at that rate, but we're still treating that money like it's never left your account, right? So it's still participating in that cash value, in that accumulation value. It can still earn interest in your policy, even though it's not technically there. Right? With the advent, particularly again, of the rate lock, but with how high the markets have been over the last, 10, 15 years, most people, when they take loans out of their policy, will choose to take a participating loan because they think that their policy will earn more than the 5% interest that they're borrowing. So they're basically betting on that it will be worth their while to pay the 5% and take it out. Because if they get 5.5% or 6%, they've earned interest on that, and they've still had the benefit of taking the money out and using it.
Gotcha. Awesome. And guys, I'll be explaining a lot of this a little bit more in depth to you guys, in hopefully a way you guys understand it a little bit easier. But are there any other questions before we let our amazing guest go? This was a great training.
Yeah, I have a question.
Yes.
Yeah.
Hey, so in the beginning, when you were touching on the loan flexibility, and you said, you mentioned two questions, like for us to look on how will the money grow and how will you get it at the end? What do you mean by that comparing to a different company? Like what should we be looking for if we're comparing or what have you?
Sure. So I mean, I'm a salesperson, so I always like those kind of like short little sound bites, the things that stick in your head that you can easily repeat. So if you're talking about a life insurance policy that's going to grow cash value for you, then really two things matter, right? So it's how well the policy is going to grow the interest, right? How well it's going to grow that cash, and then how you're going to be able to get it out once you want to start using that money. Most other insurance carriers don't have their own hedging team. So that means they don't have the rate lock, right? They don't have the auto lock. Most of them are probably using the S&P 500 as their crediting method. So the clients are going to be subjected to a lot of volatility. They'll get some years where they earn a lot of interest. They're going to get some years where they probably don't earn anything. And most consumers, right? Like if you get a 14% in 1 year and a 0 in the next year, that's not the same, right, as getting a 7 in 1 year and a 7 the next year. And many consumers don't understand how, that kind of volatility can affect the way that their cash grows inside of the policy. So for growing the cash inside of the policy, Allianz offers a lot of options. We have a lot of different crediting methods, right? We have this hedging team that's constantly coming out with new things year over year. And when we come out with new things, we're going back in time and we're adding that on to the policies that our existing clients hold. So if you're talking about like a competitive advantage, or if you ever find yourself or you're trying to sell something and a different agent's at the same client trying to sell something else, I would ask things like, What kind of crediting options do you offer your clients? What's your rate renewal history, right? So for example, if your client bought a policy 3 years ago and the cap on that in the first year was at 12%, and then in the second year it was at 10%, and now we're in the third year and it's at 8%, well, that's a problem, because how is your client going to grow that money, right, during the accumulation value if the carrier keeps restricting how much it can earn? So there are some things like that, that we run into quite a bit within the industry. The loan provisions on the back end, so you may have, I may have cut out at this point because I think my tech issue number 1 was on the loan slide. But I use Northwestern Mutual as an example for the loan provisions for whole life. So their loan provision is at 8%, right? So like I just talked about our loans, right, where I'm like, you can either take a wash loan or a participating loan, and that's 5%. Well, if you're at Northwestern Mutual and you want to take a loan out, it's at 8%. So I think it's really important that clients understand what the loan rate is and whether it can move or not. Because some carriers, right, that variable loan rate, they might be looking at something that's 4 or 5% now, but if it can move to 8 or 10% down the line in the future, they might not want to take that risk. And, again, in a situation like we're in currently with this pandemic and a lot of people losing a lot of money, we have seen some insurance carriers that have raised their fees and dropped the earning potential. And I think that's really going to hurt the consumer down the road.
Thank you.
Awesome. Any other questions, guys? I see here, let me answer a couple of these. Briefly explain crediting period. So crediting period, so that you guys know, is basically policy date, right? The crediting period for every single person's policy is going to be based on when the policy is issued, what date that is, and then 365 days every year it resets itself. So if the policy was approved, let's say January 1st, it'll go from January 1st to December 31st. If the policy is approved May 15th, it'll go from May 15th to May 14th. That's what a crediting period essentially means. And the last question from Tanisha: what is the minimum interest rate on an FIUL? Well, the floor is typically 0. So, and I'll explain that a little bit more because I know you're new to that world. But if the markets go down and perform negatively, then the worst thing that happens is you don't get anything credited towards you, but you don't lose anything to the market losses. Minimum age to apply. Nefertari, the minimum age, is it 2 weeks? Is that the youngest you need to be, Kalisha, to get a policy?
Yep. So technically it's age 0, but yeah, 2 weeks.
2 weeks after birth. Awesome. You don't have a guaranteed insurability rider, do you, for kid policies? Do you have anything like that, where the child can purchase more insurance later on as an adult without medically qualifying?
We have a child term rider that we can add on to our standalone policy. So if the parent is applying, they can add up to 4 children each, I believe. And I think that is a total of $50,000 of death benefit coverage each.
Do you have anything in the kids policy?
Not that's specifically designed for children. It would be the same IUL.
Good. And what are typically the guidelines for a child? I know that a lot of companies will say that the parent needs to have twice the amount of coverage in order to qualify. Like, how strict are they with face values on kids?
Yeah, so that is typically the baseline, right? So whatever the parents have in force, the child can have up to, half of that. Just from a situation of, we're not trying to ever create a situation where someone is worth more dead than alive, again, which sounds really morbid to say, but that is pretty standard for most life insurance companies.
Okay. Is there a number? I've learned that with IULs for kids, there's typically a number where the underwriters they won't give it a second look if the parent has twice the amount of coverage, but there's always that number where it's like, if you hit over this number on face value for a child, the underwriter is going to start asking extra questions and dig a little bit deeper. Do you kind of know what that number is with Allianz?
Yeah, again, that's another one where, it's on like a case-by-case basis. Again, because like most kids don't have any income, right? So the effect or the loss to a family, from a financial standpoint or insurance standpoint is going to be pretty minimal in the event that a child passes away. There have been some exceptions made from like a estate planning perspective or something like that, where if parents are already thinking about tax brackets or things like that down the road. I think the hard line in the sand is like $5 million of death benefit, where it's like we won't insure a minor for more than that, but that is exceedingly rare that someone even tries.
Yeah, okay, no problem. I come across issues when I get a client that says they want to put $300-400 a month in a kid's IUL. And because the cost of insurance is so low on that child, I start teeter-tottering between $750,000 to $1 million of base value, and that's when I get the majority of the questions from the underwriters. I just wanted to see how Allianz typically treats situations like that, even if the parent had twice the amount.
You know, in those situations, a well-written cover letter, you know, usually will cover most of it, where it's like, this is not a play to put death benefit coverage on this child. This is the minimum face amount that this dollar amount generates.
Gotcha. Okay, cool.
Yeah.
Cool. Thank you so much. Does anybody have any other questions?
Yeah.
Tony?
So
Marianne, hear me. Yeah, Kalisha, I just wanted to add a comment because we, of course, at Underwriters Marketing Service get a chance to run an awful lot of illustrations and different scenarios for a lot of people. And I have to tell you that, quote, older clients, late 50s, early 60s, you know, if they need to play catch up on their retirement plan, we have some phenomenal illustrations on 10 pay, 15 pay, to allow them to do that. Because as you all know, a lot of times they get caught up in having to fund children's education, or they're working hard to keep a business or a practice, professional practice going. And they turn around one day and say, oh my heavens, I'm 56 and I haven't saved a nickel. I've got to do something. Please don't lose sight of that big marketplace right now, Tony.
Awesome. Okay, cool. Felicia, thank you.
Awesome.
I
Okay.
it.
Yes, thank you very much for having me. I apologize for the technical issues. And I'll just close out. I say, I know that I threw a lot at you in a relatively short period of time, even with the breaks in between. So I can, you know, Tony, I know that you have my info. I have yours. I'll follow up after this. But for any of you who have dialed in, if you have questions, if you want more information on running illustrations or how the policy works or the marketing materials, you can get a hold of me, and either I will do that myself, or we have regional wholesalers who are all around the country that are more than willing to do one-on-one training or small group training as well. So that is an additional resource, and we will absolutely put that out there.
Thanks so much. I appreciate it. Awesome.
Awesome. Thank you.
You're welcome.
Everyone.
Okay, guys, I'm gonna break down some of what we just trained on. Thank you so much, Marianne. I appreciate it.
Absolutely.
All right, let's see here. So now that it's family now, it's family, okay? I know there's probably a whole bunch of people that have some confusions and such like that. I'm gonna break it down for you in a very simplistic way that you understand exactly what it is that that you guys have here. This is an amazing opportunity. I'm not even gonna lie to you. I've been in this industry now 15 years, and I'm excited about this IUL. I genuinely am excited about this IUL. And I'm going to give you some logic behind why they are one of the highest performing IULs in the market space. And then from there, I've already put kind of some stuff together back here that I want to kind of talk about, so you understand some of the verbiage that she was explaining that might just be obviously industry jargon that for no reason to offend you, it could be over your head, right? I mean, it's a very different outlook the way I see it than you guys see it when I've been in this for so long, right? Let me give you some perspective as to why this is such a high performing product. Number one, when it comes to these products, okay, let me change the view here because I'm recording this. Hang on one second. View speaker. There we go. Who is this person? Not exactly sure. Let me see. All right. when it comes to the IULs, really anything, it's like a seesaw. When you give something, you got to take away from something, right? So when you think about the cost of insurance that's inside of these things, you got to say to yourself, okay, well, what makes up the cost, right? Living benefits has a high cost. Yes, living benefits is a phenomenal feature to have, right? The ability to tap into your death benefit while you're alive for the purposes of covering long-term care needs, critical injuries, heart-related issues, cancer, strokes, all that stuff. It's a phenomenal feature. I'm not even going to tell you that it's not. It is. It's one of the reasons I got into the industry. However, you have to bear in mind that when you add that feature to an IUL, that's going to increase the internal cost. Even if you look at it and you're like, well, there's no cost for this rider. That cost has already been embedded in, number one. They don't have those living benefits in there. They have the long-term care need and they have the terminal illness, but they don't have the critical illness. So cancer, strokes, heart attacks, and all that stuff. They don't have that. And because they don't have that, the cost of insurance gets to be even lower, number one. Now you might say to yourself, well, is that a bad thing not to have that? Not necessarily, because you can very well sell a secondary policy like a term policy on top of that IUL that you sold to the client. That way holistically, you're selling them a plan that has the highest accumulation and the living benefits that's attached to a term policy, right? When I'm typically selling this product, I'm doing IUL, Allianz, and then I'm going to ANICO or NLG for the living benefits, because their term insurance policy is very cost effective and already has the living benefits attached to it, number one. Number two, this was a nugget that I didn't know of, but it's great to know it. They own PIMCO. They own PIMCO and they own an internal hedge fund that manages this. Why is that important to understand? Most IUL companies have to go to a third-party money manager to be able to guide them as to how these indexes are performing, so that actuaries, an actuary is someone that works inside of an insurance company that predicts, believe it or not, they predict death mortality, and because of that, they can predict the cost of insurance, right? Now, because they got to go to a third-party company to get that data, what does that mean? They got to pay that third-party company. Nobody does anything for free. And because they got to pay for that third-party service, guess what that does? That increases the cost of insurance, and the increase of cost internally affects the cash growth that you want out of the policy. Does that make sense? They have an internal hedge fund company, which means they don't have to pay that. They don't have to pay they don't have to pay a team of experts to tell them how to invest into the index, which again, lower cost means higher return on your index, right? The other piece is they own PIMCO. They own that index. Coincident, I mean, think about that. That's when you own the index, you get to keep more of the return. You get to keep more of the return that you're making based on that index, because you're not a third party. You own it. It's yours. Does that make sense? Yes, nod your heads if you do. Okay, perfect, good. So let me talk a little bit about, because don't get me wrong, I know it. I said it too, man. This is some high level training. I know there's gonna be some questions out there. So let me break it down a little bit for you. IULs, just like annuities, they have two phases: accumulation and distribution. Accumulation, I'm putting money in. Distribution, I'm taking money out. Okay? When you're putting money in, you can pick different indexes to make an interest rate off of. The top two she talked about was PIMCO and somebody help me with the next another one. Was it the Barclays? No, it wasn't the Barclays. Somebody help me with it.
Budby.
Bloomberg. Right? It was those two, right? The reason why is because those two play on a participation. When you go into an index, this is what you're basically saying. You're saying, hey, if the market goes up, I'm going to go up with it, but to a limit. When the market goes down, I'm going to flatline. I'm going to get a 0% return. So the person who asked the question, what was the question? What's the minimum interest rate on the FIUL, which is Tanisha? It's 0. The minimum is 0. Because if the stock markets crash and everybody's negative, 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 the worst thing that happens to the client is they don't make anything, but they don't lose anything. Why? Because an index has a floor. That's really that's the reason why people go into this. They want a floor, but in exchange, they have to be willing to have a ceiling. The insurance company says, listen, we will not make you responsible for any of the losses if the markets crash. We'll take the losses. We're not going to pay you anything that year, but you're not going to lose anything. But we want a ceiling too. We want a limit to how much you can make because we've got to make the return above it. So the insurance company's playground is under zero. That's their responsibility. But over the ceiling is also the insurance's playground because that's their earnings, right? Now, participation versus caps will dictate what the floor and the ceiling actually are. A cap is simple. A cap says, hey, you're capped at 10%. So if this index makes 12, you're making 10. If the index makes 15, you're still making 10. Your ceiling cap, your limit, think about it, right? The cap on the bottom, that's the top, is whatever that interest rate is. That's your cap. A participation, however, says you're going to make a percentage of whatever this interest index makes. The current participation on these plans is 140%. It's over 100%. That means this. Let's say the stock market does 10% and you're at 140%. Somebody tell me what's 140% of 10%. Anybody know what the answer to that is? 140% of 10%. It's 14%. That's what it is. Because 100% of 10% is 10%. What is, I mean, think about like a pie. 100% is the whole pie. If the whole pie is 10%, you just made 10%. But what if it's 140%? That means you made the pie plus 40% more. So 10% plus 4% is 14%. That's pretty sexy to have a participation. That technically says you don't really have this ceiling to deal with. You don't have that ceiling to deal with, but you're still going to get the floor. So accumulation period means I'm putting money in, I'm putting money in, I'm putting money in, I'm putting money in, and I'm making a return based on this particular index, which Allianz is using 50% of the money in PIMCO, 50% of the money in Bloomberg. Does that make sense, or are there any questions? Okay. Index 101, just so you understand. PIMCO, Bloomberg, S&P, Barclays, all of those, all they are is a collective group of investments jumbled up into that cluster. S&P 500 is the most commonly known because it consists of the top 500 US stocks in America. That's why it's called S&P 500, Standard & Poor's 500, the top 500 companies. And an index, and the index itself of these 500 companies is what is the difference? First off, what's the average of all of them? What's the average of all 500 companies? And then what's the difference of how they perform from this point to this point? Typically year to year, point to point, right? So from like right now, we're sitting on May 3rd, right? If a policy got enforced today, May 3rd, it would go from May 3rd to May 2nd. Because if you add all that up, it's 365 days. So the index says, how did these 500 companies perform from this period of time to this period of time? Did it go up? Did it go down? Did it stay the same? Based on where it started. So it starts here, it ends here, that's a positive index. It starts here, it ends here, that's a negative index. It starts here, it stays here, that's a flat index, it stayed the same. That difference is the index. So when you see a 10% index, it doesn't necessarily mean that these 500 companies only made 10%. It means that there was a 10% difference from where it started to where it ended, right? If it's a participation and there's a 10% index, that means the client's going to make 140%, right? Because it's a participation. But that's what an index is. It's just a collective group of investments clustered together by an organization. S&P is Standard & Poor's. That's the name of the organization. Right? Bloomberg is the name of an organization. PIMCO is the name of an organization. There's a bunch of money managers that say, this collective group of investments, what's the shift? What's the shift from point to point? That's an index. Does that make sense? Okay. So when you're putting money in during accumulation, that's how you're going to make. Can you do a quick illustration? I can, and we will if I get some time. I got no problem with that. But the biggest thing you need to know is during the accumulation period, that's how you're earning money. What's the benefit? If these indexes go down, you're going to get a 0%. If these indexes go up, you're going to earn. So think about a sports fanatic, right? Think about a fair weather fan. I tell this to my clients all the time. What's a fair weather fan? Anybody know what a fair weather fan is? Somebody tell me what a fair weather fan is.
Someone who's only in it when things are good.
Correct. That's what a fair weather fan, a bandwagon jumpy is what they call them as well too, right? Which means you guys remember seeing that meme where Homer Simpson is out wearing a jersey, but if the game is bad and he's losing, he hides inside of the bushes, right? That's a fair weather fan. That means the game is good, the jersey's on. We're winning, I got the jersey on. We're losing, I'm taking the jersey off. I want nothing to do with the team. I want nothing to do with the team if the game is bad. That's kind of how indexing is. If the market's winning, I'm participating. I'm going to win. If the market's losing, bro, I want nothing to do with that loss. You deal with the loss, Mr. Insurance Company. I don't want nothing to do with it. You deal with the loss. It's a fair weather fan. So imagine if you could do that with your money, where you say, listen, you're going to make money when all of these investments go up. But if these investments don't go up and they all lose, don't worry, you're not going to be responsible for any of the losses. That's what an index does. So during the accumulation phase, that's one of the many benefits that you get, is that ability to know if the markets go up, you go up. If the markets go down, you don't go down. So you're not losing anything from the market. Where could you lose money? Cost of doing business with that company. But the company is saying, hey, listen, we don't have living benefits, so that cost is removed. Just wipe that out. Right? And our hedge fund company that creates all of these indexes is an internal one. So we don't got to pay a third party person. So that cost is out. You see what they're saying? They're saying the cost of doing business with them is lower than any other IUL. And the return by default is also going to be higher than any other IUL. That's accumulation. Now, what does the rate lock mean? I'm going to give you what the rate lock means here, because that is enormous. I'm going to tell you right now, that's enormous what a rate lock is. By the way, remember this acronym here, GRIP free, GRIP free. That's how I explain IULs. If I could show you something that has G, guarantees, right? Everybody loves the word guarantees, gives you a strong R, rate of return, okay? Can give you the option to have I, income for life, as well as P, protection, insurance, as well as making sure the money is tax-free. Would you be interested in learning more? That's a grip 5, right? I say that, hey, what if I can help you get a grip of your money, right? We all want to get a grip of our money. Well, what do you mean by grip? Well, I'll give you a guarantee with a strong rate of return, income for life options, peace of mind protection, and tax-free earnings. Would you be interested in something like that? Do you have something like that? Don't worry, I'll wait. Right? I don't got nothing. Okay. Would that interest you? It would. Well, let's sit down. Let's have a conversation. I work with a team of specialists that specialize in that area, and I want to show you what the Wealth of America is doing that you could do based on your budget. And then you schedule a meeting with you, that person, and an expert inside of our organization that can help you in a field training meeting. Look at that language I just gave you. You could be a week into the game, and all you got to know is how to have that conversation. Talk about grip 5 and not know anything else. And as long as you can schedule a meeting because the person wants to know more about grip 5, you have a field appointment to learn from a specialist that knows how to sell it, right? But let me talk for a minute about the rate lock, what that means. Remember point to point. Today's May 3rd. Okay. May 3rd, bam. 365 days takes us to what? May 2nd, right? This is May 3rd, 2021. This would be May 2nd, 2022. Sorry. May 2nd, 2022. That is the point to point. That index is gonna do what? It's gonna do this. It's gonna go up, it's gonna go down, it's gonna go up, it's gonna go down, right? That's what an index does. It's a collective group of investments, and all of those investments sometimes go up, sometimes go down, sometimes go up, sometimes go down. When you invest into an indexing fund, you're saying this market goes up, boom, 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 I go up. When it goes down, I stay where we were. The market goes up again, I go up. The market goes down, I stay where we at. The market goes up again, I go up. The market goes down, I stay where we at. You see how it creates this kind of a staircase effect? All right. Rate lock means this. When the market is up, right? Let's say the market let me change this a little bit so that it makes sense. Let's say this is what happens with the market, right? When the market goes up, you say, hey, I want to lock it in. Let's lock it in right here. That means for the rest of the year, that's the interest rate you're going to make. Even if the markets go down, you're locked in at that higher rate, no matter what. You know what that means? That means that typically you'd make a positive interest here during this part of the year, but then in this downslope, you wouldn't make anything. You'd make 0, 0, 0. But because of the interest rate lock, what they're saying is, let's pay you the remainder of that year at that interest rate. Let's lock it in as though the market didn't drop anymore and it stayed there for the rest of the year, so that's what you earn. You're locking that in. Does that make sense? That's what a rate lock is. So think about it like this. If the illustrations that we run show 6% average rate of return, wouldn't it be wise to tell your client, listen, when the market gets up to 8%, lock it in. And I can guarantee you on that year, you're going to make 2% more than what I even showed you on the illustration. Oh, and by the way, Mr. Client, if the market increases above that rate lock, you're going to go up with that lock as well. You're going to go up with that increase. So even if you lock it up at 8%, knowing, damn, 8%, that's a great interest rate to make for the remainder of the year. That's a great interest rate, I'm going to tell you right now. But if the market does 9, you're going to get that too. The market does 10, you're going to get that too. But lock it in. Lock it in. And you get to lock it in until the next anniversary. When the anniversary happens, a new 365-day period begins. You have to now reselect if you want to have a rate lock, if you don't want to have a rate lock, and if you do, at what rate do you want to lock it? She said she's pretty aggressive. She's fairly young. It makes sense. She locks it in at 12%. So she's basically saying, hey, listen, if the market at any time in this 365-day period gets up to 12%, lock it in. For the remainder of the year, I want to make 12%. Even if the markets go down afterwards, I'm not going to lose anything to a down market, but I'm not going to make anything. I'd rather still make 12% if I lock it. Does that make sense? I'm looking for the faces of the newer guys, the newer people that just came on board, especially my technical ones. Tanisha, do you understand what I'm saying?
Tony?
Yes.
My understanding there was on the lock that you don't, once you've locked it in, you're not going up or down. So you're not going to, you lock it in at 8 and the market does 9, you're staying at 8.
Nope, that was my understanding as well too. And then she corrected me when I asked her, if the market goes up during that period of time above the lock, they're gonna increase your lock to the market increase, which makes this a whole lot even sexier now, just so you know. Howard, if your toes are curling, I understand why.
Hey, Tony.
Yes, ma'am.
Okay, so yeah, I did have a question, just just even understanding indexes and all that. So with the accumulation, how is that credited? So like say it is May and they lock in at 10%. Well, is that they earn 10%? Is that credited for the entire period year? Or is it that whatever rate they accumulated the other 5 months before, like how often is it credited?
So
that's what I'm trying to figure.
So at a policy anniversary,
Okay.
you get credited for that year. So if you locked it in up here and the market hit that, and for the whole year, that's what you would get. That's what you get. Does that make
Okay,
sense?
so it doesn't matter. So if, say their calendar year was January 1st to December 31st, doesn't matter if December 26th, if they lock it in at that 10%, that whole year, they get that 10% applied to their accumulation?
I want to tell you 90% yes on the rate lock. Yes, I know that it's credited from point to point, year to year. So theoretically, what you're saying, yes, if the day before the anniversary, you decide to tell them, here, let me throw in a quick rate lock, right? And it just so happens coincidentally that on that day, the market skyrockets and you hit that lock, that's what you're going to get for the rest of the year. Does that make sense? And why the rate lock is beneficial is because of this. And this is just a very simple example. Simple. Let's say the market starts here and it goes like this and then like this. Technically, it's a positive market. You started lower, you ended up here. You would technically, without a rate lock, make the difference between here and here. It's a positive market, right? But because there's a rate lock, say right here, instead of getting the difference between here and here, you're going to get the difference between here and here, which is a higher number. Let's say this is, 10% and the markets close at 15%. That's a 5% difference. But up here, there was a 20% mark. So the difference between 20 and 10 is a 10% difference. You make a 10% instead. That's why the rate lock is such a powerful tool. Without the rate lock, you're still not going to lose money. You still have that peace of mind of a floor. But with the rate lock, you get to max out on any positive performing months and lock in for the rest of that year. Does that make sense? Yes, yes, yes. Okay. And guys, I promise you, you're not going to capture everything in this one sit down. It's taken me years to understand the internals of this type of a product. Howard, I know you might still be kind of questioning what I had mentioned to you, so I encourage you to call them tomorrow and ask them, because that was one of the things that I asked her. I said to her, I said, if you lock it in and the rate goes above the lock, do they readjust the lock? And she stated that they did, which made this product 10 times much more attractive because of that. Does that make sense?
Yeah, I'll call them.
Oh, I'm sorry.
So
What I understood from the rate lock is what she said was, by the end of the day, if let's say you wanted the lock at 10%, but it goes to 11% at the end of the day, then it locks it at 11%, and that's what you're locked in for the rest of the year. Now, if it goes into 12% the next day, it doesn't go, your lock doesn't adjust to 12% the next day. It's just whatever, however it locked at when it hit that 10%, however much it was at the end of the day, if it was higher, then you get that higher rate.
And I believe you're 100% right. So what you're basically, it'll allow for a readjustment only one time.
I don't see it that way. I have to be honest. My interpretation of that is that if you lock it in at 10% and it hits 10% during the day, but it goes lower at closing, you don't get that rate lock. If it goes higher than your rate lock during the day, then they lock it in. So if it goes to 10% during the day and then it goes to 11, you're locked in. And then later on in the afternoon, it drops down to 6, they'll lock it in.
I'll tell
So
you,
it has to go above your lock-in rate.
Before we go back and forth on it or what we all interpreted, let's just give them a call and confirm that this week with everybody.
Sounds good.
Okay, because I interpreted it differently, but I could be wrong. It could be a different way. Let's finalize on that piece. But before I want to move to the next piece. Does everybody kind of understand what happens during accumulation? Because I definitely want to talk a little bit about distribution, because the loans is a big thing. She said a gold nugget there. She said a lot of companies will accumulate nicely, but then when it comes to withdrawing the money out, they don't have very good loan provisions. So I really want to talk about that, because that is if you understand that, you are better than 90% of the people in the IUL space, because they don't even understand that one. See, one thing I want you to understand, especially I say this with 401ks, it's not about how much you make, it's about how much you keep. And if a 401k is fully taxable and you got $1 million in there and taxes are at 70%, are you a millionaire? No, you got 300,000 because you got to give Uncle Sam 700,000. It's not about how much you make, it's about how much you keep. The loan rate determines that. So let me explain that piece. And I'll get back to you guys on a better answer with regards to the lock with that loan lock. I mean, that rate lock provision. Let me explain the loan. When you hit retirement, you have two ways you can take the money out. You can do what's called surrender withdrawals. That basically means this. That means, you know, my money grew from here, 100K, to here, 200K. I made $200,000 in profits, right? Bam, it's here. This is what it's worth. I have a $500,000 insurance policy. If you do a withdrawal, you're saying, hey, give me 20,000. Let's say you want to take out 20 grand and you're going to do it as a withdrawal. You're saying, hey, give me $20,000 of my money. So by the time when you give me that money, I'm going to have 180,000 left over. That's a withdrawal, right? My insurance policy is going to reduce from 500,000 minus the 20,000, right? It's going to reduce, okay? Now, that's a full-blown withdrawal. If you take it out in the form of a loan, however, what you're basically saying is to them, you're saying, hey, listen, I got 200K in here. I want to take out a loan, okay? A participating loan means this. The 20 grand that you give me is not going to come from my 200,000. The 20 grand you give me is going to come from the insurance company's money. It's a collateralized loan. The insurance company is going to give you the 20 grand because they know you're good for it. You got 200 grand in their bank. They're going to give you 20 grand of their own money. Why not? The participating means that this 200,000 you have in there is still going to earn interest every year based on the indexes. So if they're loaning you their 20,000 at 5%, but your 200,000 is still earning an interest rate, let's say the interest rate is 6%, right? You took out 20 grand of the insurance company's money times 5%. That means that at the end of that year, you're paying them $1,000 in interest. Meanwhile, your 200,000 earns 6%. You just earned $12,000 that year in interest. Your money's still participating in the index. That's why it's called participating loan. Your money's still earning based on the index because you're borrowing the insurance company's money. The insurance company says, hey, your loan rate is 5%, so it's $1,000, but you made $12,000 over here. What does that mean? That still means you netted 11. Because even if you pay that loan back, which you should, right? Take my proceeds. Oh man, I made 12 grand. Here's the $1,000 that I owe you for the money that I just borrowed, right? But I still made 11 grand. By next year, your 200 grand went up to what? Went up to 211. Yet you took 20 grand out, tax-free. That's the benefit in a participating loan. You're borrowing the insurance company's money. You're not borrowing from your money, and your money is still participating in the index. A non-participating loan means this. I want to borrow 20 grand from my money. I want it to be non-participating. So when I take 20 grand, I'm taking 20 grand from my money. That means that I now only have what in there? 180 grand that's participating because I took 20 grand of my own money. That 20 grand on a non-participating loan is 2%, not 5%. So let's do the same thing. 20 grand at 2% means I'm paying the insurance company $400 to borrow against my own money. Meanwhile, my 180 grand that's left over, it made, let's say 5%. 5% means 9 grand. I made 9 grand in profits, but I paid 400 in interest to borrow against my own money. So next year, I have 180 grand plus the 9 grand that I made, minus the 400 that I paid in interest. I did that wrong, sorry. 180 grand plus the 9 grand I made, plus the 9 grand. which is 189 minus the $400 I paid in interest, I still have 188,600 in there. You see how you're still earning more money than what you're paying out? Does that make sense what I just explained?
So Tony, I have a question then. So
Yeah.
when you're doing the participating one, right, and
Mhm.
you're actually borrowing the money, they take the interest right away at the next year, right, for whatever we have to give back to the company for the borrowed money. And how do you pay off the 20,000 that you took? It's
That's
like
what-
when you die, that's when they take it out of your death benefit?
Exactly. So
Okay.
the idea is that loan continues to grow, but it's not growing at the rate that your cash is growing. Your cash is still growing greater than the loan. And what ends up happening is we design it so that when the person passes away, the death benefit is used to pay off the loan. And you never yourself, as the insured, had to pay that loan yourself. You never had to write a check for that loan that you used, and therefore you were able to take out all that money tax-free. Because a lot of people ask me, well, why borrow? Why borrow? The reason you borrow is because you cannot be taxed on loan proceeds. So you get to take out all of that money every year, over and over and over and over and over and over again, completely and utterly tax-free, knowing that the amount of money you're borrowing is still less than the interest rate your very own money is earning. So when you pass away, you just pay off the balance of the loan with the proceeds of your insurance policy and then leave the difference to your family. That's how you avoid Uncle Sam's wrath of him taking 33% of your money in taxes, or the risk of what we all face in the future, 50 and 60% in taxes, because it's tax free. Can't be taxed on loan proceeds. Does that make sense?
Tony, may I ask a question?
Yes, ma'am.
So in that scenario, you would have to make sure with this particular company, you would have to make sure that you locked in at above, whenever it was above 5% in order for that to play out, right?
Correct.
Or you don't.
Yeah, so when you do participating, if you heard what she said, she's like, that's for the aggressive person, because what they're banking on is that the index performs higher than the 5% loan that you're being charged. But even if you're not, let's use that scenario. Let's say 200 grand is in there. You borrowed $20,000 in a participating loan. That 20 grand is being charged 5%. That means $1,000, right? Right, 20 grand times 0.05, $1,000 in interest that year. Let's say the market doesn't do 5. Let's say the index doesn't do 5. The index only does 3, but it's 3 on the full 200,000. So what's 3% of the full 200,000? It's still 6 grand. You still made 6 grand on your money, but you got to pay 1,000 in interest or accumulate 1,000 in interest on that loan. You're still making more money than the loan is charging you. Therefore, the policy will never get to a level where the loan is higher than what you're earning. That's the power of these products, and the ability to let your money defer for such a long period of time that you get to borrow the money out tax-free and never owe more money than what you're still currently making while you're taking the money out. Does that make sense? Kind of, sort of, maybe? Okay. I'll tell you what, let's do this. Let's have another training session, because right now what we're going through is information overload. It's better if we look at it on an illustration. You can see how each of the categories adjusts. Let's have another training on that. We'll break down the illustrations. But the biggest thing I want you guys to understand, this is a huge benefit to you. If there's one thing I want you to remember is the grip free. Grip guarantees strong rates of return, income for life, okay? Protection if you pass away. And this is going to earn an interest rate tax-free greater than any other IUL we have in the market space. Okay? Okay.
Tony, quick question.
Yes.
Does Allianz have income for life?
Does what?
Do they have the rider income for life or no?
Well, you can structure the plans to draw out income for life, or you can annuitize it. All IULs allow you to annuitize for income for life. Okay.
Thank you.
All right, guys. I'll let you guys get going because, again, I think it's a lot of information all at once. We'll chop it up into little bits and pieces and get you to understand it better. But please realize this is the strongest IUL in the market space, pound for pound. pound for pound, one of the greatest tools you guys want. And we'll talk a little bit more. Give me your feedback on the group chat. I love your feedback on the group chat. Okay. Thanks so much, guys. Bye-bye.
Thank you, Tony.
Bye, guys.